Good afternoon, everybody. Stock here from OnTheMoneyOptions.com. It is Monday, March 18th, first day after option expiration week. Had a good day today, and so we'll take a look at the technicals to see what might be coming our way this week. We're very near the highs for the S&P 500, so again, that gets to be a little bit dicey. People get a little bit worried. You can best be prepared by sort of understanding what's going on in the market and what the internals are telling you about where we're moving and what areas of the market are the strongest. So with that, let's just take a quick look at the relative strength analysis for this week for each of the now 11 sectors, and you can see that technology and utilities are the big winners so far for the past month. Consumer services, which was broke out of the discretionary, so consumer services, the real estate portion of the financials are doing well, and materials are doing well. So you're looking at is where all of the movement is coming from, the upside to the market, and it all looks pretty narrow, but mainly in technology. So just keep that in mind. Looking at the asset classes, you can see this is the new highs minus new lows percentages for each of for the S&P 500, the mid cap, the small cap, and the NASDAQ. So this sort of gives us an impression, an idea about where things are moving in the market. And as you can see right now, the small caps are the only ones that are on a percentage basis putting in more new lows than new highs. So this suggests that maybe there's some weakness underlying the market, and the risk is off a little bit right now with a lower amount of small cap investment. So this is just something to keep an eye on. When the market's near the high, you need to understand where the weaknesses are and where the strengths are, and you need to move to those places so that you can exploit that. Now, moving on, looking at the bullish percent indicator, what I want to point out in this chart is you see that we put a 3 in. The 3 stands for the first mark that happened in March, and we were on a column of X's at the 62 level. We're now at the 59.17 level, which means that they've come off some, and we're down now to 59.17% stocks on point and figure buy signals. For this point and figure buy signal to switch to a column of O's, a lot of people are not familiar with this style of charting, but this takes a lot of noise out, and for it to switch over, you got to have a 3-box change. So we need to go below the 50 or down to the 56 level for us to actually drop back to a column of O's. So again, this shows that even though prices are very high, the indexes are very high, there's still some weakness at the upper end. Now, moving on to the advanced decline line, you can see that over here on the right-hand side of the zoom in the top panel, you can see that we've put in a higher high. We did have 1,213 more stocks advancing than declining today. So on a cumulative basis, we're moving back up. This is a higher high, and we're moving back close to the channel. So this still looks good. It looks, I wouldn't say strong, but it certainly looks like it's headed in the right direction. Now let's take a look at the relative strength. I look at relative strength for the SPY, which is the S&P 500 ETF, and I look at it on a weekly basis, sort of take a little bit of the noise out. And as you can see, over a long period of time, in big moves up, we've seen the relative strength indicator above 60. Well, we're above 50, which is good, but we keep bumping into the 60, and I'd like to see this creep up above 60 and continue to move up in order to suggest to you that we may see more movement coming in the near future. So again, this indicates that the market is strong, but not necessarily on fire. And this gives you good reasons to keep a sharp eye out and maybe take some profits when you have good profits so that you don't lose them in a quick turnaround. Here's the rate of change for the SPY, and I'm going to say it again, we're still below zero. Below zero is still a dangerous place to be. If you can look back in the previous times, 2016, 2012, and of course during the Great Recession, we spent quite a long time below the zero line. And one of the things that you'll notice is that you don't put in a new high, long-term high on the market until this gets positive again. So looking particularly at the 2016 level, you can see that we spent 6 months under zero, and we did not break out to a new high until we moved back above it. So I would say that we're waiting to look for new highs in the S&P only after this moves back above the zero line. Now moving on, taking a look at some of our risk factors. This is the small cap index RUT relative to the SPX. Typically when you see the market advancing and more stocks participating in the advance, you'll see the Russell relative to the SPX go up. This is still, I think, at a weak level in the 0.55 range, but it did move up today, and we'll just have to watch this and see. But I think what this is telling me is that we're in a sort of a precarious area of the market right now where there's a lot of doubt as to whether or not we can advance from this point. So again, the whole purpose of studying the internals is just to be aware of what's happening and what might be building up so that you're not caught by surprise. Moving on and looking at the equal weight relative to the S&P. Again, this tells me about how many stocks are really participating in this move up in the S&P 500. And what you see here is that we've come off of the highs and we're back down almost to 50% retracements. So this tells me that a lot of the lower cap stocks in the S&P 500 are really not participating in this market right now. That again suggests that everything is crowding toward the big cap stocks at the top of the index. And this is just something to keep an eye on. This suggests that there might be some weakness underneath it, and you need just to be aware of that. Again, and look maybe for opportunities to take profits and set up some short positions if you see the opportunity. Here's the put-call ratio on equities only. We're in a pretty normal range here, not too extremely optimistic or pessimistic. So this looks okay right now. As far as I can see, there's no real dark clouds on the horizon based on the amount of protection that the big boys are putting into the positions. Finally, looking at the VIX is quite low, the lowest it's been in a long time. And this suggests that at this level, at 13, you're looking at an expected move in the market below 1% each day. So again, that suggests the volatility is rather low and we're just sort of plugging along. And we're going to be waiting to see what's going to happen with the next set of earnings that are coming out in the next few weeks. So I'd say right now we're up high. We have some things that suggest that it's going to be difficult to get higher than this, particularly with the rate of change. We need to see that come back in. We need to see the equal weight broaden a little bit if we're going to make new highs. So right now I think it's a good time to look at opportunities to take profits out of stocks and look for stocks that are beaten down in some of the beaten down sectors and look for them as an opportunity to go to when you begin to see a big rotation. So anyway, this is Doc from On the Money Options telling you to trade smart and stay hedged.